Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Stuart Martin of Thomson Reuters, and we're going to talk a little bit about how asset servicing is evolving. So can you talk us through some of the market developments?
Yes, certainly. I mean, I think we're seeing at the moment quite a lot of activity in that space, particularly within the fund administration and custodial world. Two areas are really coming out at us quite a lot, and one of those is around the cost and productivity of the banks themselves. They operate with a lot of legacy in terms of infrastructure and process. But since the financial crisis is really kicking in and a lot of the new regulations are coming into play, they're really finding themselves having to look at what their processes have been in the past and really, trying to optimize the process to get the most out of it, but equally drive down the costs of how they're paying for services at the moment. So that's one area. And then the regulatory oversight, of course, with a lot of new regulations coming into their buy-side managers, that has an impact on the custodial world where fees are being pushed down. And obviously the regulations that are being pushed on those investment managers are almost in some ways stopping the flow of investment, which obviously has a knock-on effect on the way that the asset servicers need to deal with that business.
Mm-hmm. So what role do the prime brokers play then?
The primes are quite interesting. We're seeing a lot of diversification of their traditional book of business. There's a lot of activity where bulge bracket primes, so the big global prime brokers, are actually working with a consortium of mini primes to get at niche business that they wouldn't necessarily attract directly as a big prime broker. So some of the startup funds and smaller fledgling hedge funds, for example, are almost collectively pooling their assets and then going via a mini prime into the bulge bracket prime. So that's something we're seeing quite a lot of, particularly in the US. And I'd also say for the prime brokers, there's quite a lot of a referral business activity happening where, if your core business is capital intro, as a prime broker, you might be offsetting certain business that's not quite core to your market into a relationship you have with a different prime broker. So there's a lot of sharing of services to ensure that costs are optimized around your core business and focuses on your core business.
So I'm going to move into our industry's favorite topic, which is regulations. So how are regulations really impacting this sector?
It's all over the place. I mean, there's a lot of regulations, particularly on the buy side, the investment management side of the industry, and that has an immediate knock-on effect into the third-party administrators. Not only have they got to be aware of what these regulations are and how to manage them, particularly on behalf of their clients' needs, but they have to invest in trying to manage around those as well. So again, that also has a knock-on effect in terms of the investment flow that funds are actually picking up, and that will have a knock-on effect in terms of trading through prime brokers, so fees, and obviously, things like Solvency II, there's a lot of diversification in terms of how funds are actually balancing their books and demonstrating capital adequacy, and then obviously the administrators need to be able to match that as well.
Yeah, it seems like capital adequacy is the term of the moment, right?
Yeah, exactly, yeah. Everyone's worried about it, everyone's finding it difficult to actually come up with the relevant and transparent information to perform that analysis.